Hi everyone. So today is our eighth session for strategic financial management. And last week, what we did was we tried to do ratio analysis in order to kind of identify how managers or any user could analyze the financial statements and try and in order to make decisions, right? So this was trying to analyze. This was mainly because it was needed for decision making, and we used a lot of methods, different types of ratio analysis methods to identify how the company is performing. However, at one thing that we need to understand at that point, we spoke about things which are physical, which was included in the financial statements. However, there is also some things which are not included in the financial statement, which will be useful for organizations in order to do their assessment or kind of analyze their company position, right? So that is what we are going to talk about today. So we are going to talk about industry intelligence and then how we will be assessing intangibles. So industry intelligence. So first we'll see what is intelligence. What is intelligence? Basically, if you look at information that has been analyzed in order to make any type of decision is generally called as intelligence. So what is industry intelligence? Obviously, that is the approach that obviously a management takes, allows an organization to kind of define what information is useful for the organization's decision making, that and the information which is being analyzed in order to take specific corporate decision making. So companies could analyze information which are in order to provide required information to the management for decision making, because it's very see, when it comes to an organization, it does have different types of managers, right? Because it has a lot of departments. So the same information will be used to make different decisions by different department heads with different ideas. So therefore, it is very important that all information is shared, and so that the decision making is properly done. So it's therefore the knowledge of the industry is very important today, because it's a rapidly changing kind of business environment, and the organization needs to kind of work towards a situation where organization decisions are properly aligned. So there are some assets that, so now we are going to move on towards intangibles. Now, what is intangibles? So now when it comes to what is tangible resources? First, before talking about intangible, let's see what tangible resources are. Tangible resources are things that have physical substance, like a land, a car, something which has physical substance. But intangible resources are the ones which don't have that physical substance. Example, these are things which would add value to the resource, or add value to the company in order to run and earn profits in a manner that would be profitably, add value to that organization. What are things that come to the your mind? Like example, let's take McDonald's. Okay, so McDonald's, if you look at the value of the value of whatever the cost or whatever of a McDonald's burger, and a burger at another small shop, it could be the same taste. I'm not saying there should be a little difference. However, what I mean is McDonald's, because everyone knows, they do go there, right? But when it comes to a small shop, people would, even though the taste is a little similar, people would think a little bit twice. However, it would be less. So McDonald's will be expensive than small shop. So what is that? So this is basically that intangible value. So basically the intangible assets are things like goodwill, patent, corporate image, brands, distributor network, the business processes. So basically what happened with McDonald's was the brand name. Everyone knows McDonald's. They know their food should be okay. So yes, for the brand name, the customer gives that extra premium amount. So when it comes to intangibles, these brand names and things of that sort will always add value, the market value of a company. Are they presented in the financial statements? No, they are not presented in the financial statements because they basically, they are something that adds value. So the profit obviously increases, but you don't have a section called brand value in the financial statements. However, if a company acquired another company for a premium, then obviously that particular extra amount will be included as intangible assets in the financial statements. However, if not, the brand name is not included in the financial statement. And so that shows you, like, just deciding based on financial statements, doing ratio analysis, is that sufficient to make decision making? No, it is not. Even the intangible assets and their contribution needs to be included. The industry intelligence need to be included in order to make proper decision making for an organization. So that's why we are going to kind of talk about this area today to ensure that you all know how the manager should assess their company, not just using the financial statement, but also including industry intelligence as well. So now I said about intangibles. So first, we are going to talk about intangible resources or the intangible property, what it is exactly. So these are basically legally protected ideas, names, or concepts with a new product. So intangible property can be like important to an organization and cannot be kept in, like, see, compared to the physical assets. Now, physical assets, you can just keep it under lock and key, but intangible property, is it something that can be kept in using lock and key? No, because you can't even see it, right? So for that, to protect the intangible assets, what is used is the legal mechanism, which is basically sought to protect the rights of the human intellectual property owners. So so let me just give you a small example for you to understand how it works. So the example of a trademark dispute. Now, Apple Corp, which was founded by the Beatles, but this is not the Apple products that we're talking about, but you'll understand what. Apple Corp, which was founded by the Beatles, was the owner of Beatle record label and Apple Records, and filed a lawsuit against Apple Computer for trademark infringement in 1978. So in 1978, Apple Records, a Beatle record label, was very famous. Even though, obviously, Apple Computer and those are very famous right now. It's a well-known brand. Back in the day, in 1970s, Beatle record label or the Apple record were very famous. Therefore, when Apple Computer used its trademark, they filed a trademark dispute at court. So in 1991, the dispute ended and there was a settlement of USD 26.5 million, which was given to the Apple Corp from Apple Computer. So just imagine now Apple, people don't even don't even know what Apple Records is. However, Apple Computer or iPhone or Mac, so very famous brands, right? So this was the start. Back in the day, Apple Computer was, they had this dispute where they had to pay for Apple Copper back in the day, because the Beatle record label or Apple Records actually had a better, how do you call it, better brand. However, during the settlement, it was agreed that Apple Records will always have that they will have the right to use Apple to any creative work or anything to do with music, because that's what they do. And Apple computers can use it on goods and services to reproduce, run, play, or anything. So obviously they have been using it properly. Obviously, there's so many goods and services related to Apple now. So Apple is it's a well-known brand name. So that's after that. So can Apple produce produce music? That's a question, right? Yeah. So now talking about intellectual property, there are 4 types of intellectual property. One is patent. So basically, this is like the monopoly that is granted by a government to prevent, others entering where the inventor can make use of what they have produced. And trademarks are like exclusive grant given by the government to use a specific name, like a symbol for an organization, product, or it can be a service. Now, trade secrets, it's like the business secret, which leads an organization to kind of occupy a competitive advantage. Example for trade secret, what comes to your mind? Coca-Cola, the secret ingredient. That should come to your mind when you say trade secret, hopefully. So copyright, exclusive rights provided by a government to copy or distribute an original work or expression is called a copyright. Yeah, so those are the 4 sections. And now we are going to talk more about these 4 sections actually. So hold on. Oops, yeah. Yes. Sorry. Oops. Sorry, I've just skipped something. Oops. Okay, sorry guys, I've kind of messed up a bit. Give me some. Yep. So, yes, here we are. Kind of messed up. Okay. Where were we? Yes, we were talking here. So let me, yeah, as you can see. So now I'm going to talk about each section, right? So patent. Patent prevents, as I said, others from using an invention to a period time such as 20 years. So the inventor could have a monopoly and get some kind of return and disclose publicly about it. Okay. So patents are 2 types. One is the design patent, so which is basically restricting others from copying or producing or selling something identical with ornamental design. Okay. There is another thing called utility patent, which provide others from using an invention that is related to a niche process. Now, this is the design is an ornamental design patent. Utility is a process or machine or some kind of method of improvement, which is improved from the existing product. Now, utility patent are used for new and useful processes like machine manufacture or composition of matter. So in order to obtain a utility patent, the invention should satisfy three main criteria. One is useful. It has to, the patented invention should use to someone in some perspective, and it should be a novel thing where the invention should be something which is previously publicly unknown, and it has to be non-obvious, like should be something which is not clearly evident for others in the field who are looking for like a solution. So moving on, we're going to talk about the patent or the design patent. So what is design patent? Now, a design patent basically does not carry much value, like for engineering project, because they are restricted to like an ornamental design. Now, as you can see, when you see this particular design of a bottle, what comes to your mind? Doesn't Coke come to your mind? Actually, Coke has a design patent for this particular ornamental design. So I'll just explain to you a little later. So in countries such as Kenya, Japan, South Korea, inventors are kind of offered registering design instead of design patent. Okay. So, and as you can see, it shows the US design patent D48160 for the original Coca-Cola bottle. So this is the original Coca-Cola bottle, and Coca-Cola has a patent for this bottle design, not just the secret ingredient. So Coca-Cola has a lot of patents, as you can see. So intangible, now we are going to talk about difficulty facing obtaining patent. So when invention has to qualify for a patent, right? But it is, if it's a new invention, it's not too difficult. However, if it's if to say that it is a non-obvious kind of patent, the innovator will have to spend a lot of time and money to challenge and show that, you know, their particular they deserve to get a patent. And also another thing is basically the employee. Let's say the inventor may not always necessarily be the owner of the patent. So like, let's say, like in some cases, there are employees who are inventors in the company. However, the organization will be the owner of the patent. Okay. So rights of a patent owner. So there are two types. One is the defensive right, then the offensive right. So patent owner can kind of include others for producing, selling, or using the product based on the same idea. And the event of infringement, what happens is these rights are known as offensive rights. So in other words, patent help to kind of publicize the innovation through a legal system and blocking competitors from entering the market and from from competitors from patenting the disclosed invention. So now we are going to move towards branding. Now, what is a brand? Brand is basically a name or symbol or something of that sort, which could identify particular goods or service, a seller, group seller, while differentiating from another person. The brand could be viewed as a personality, or it could be something which a customer, inventor, someone can identify. So like a good brand could have the following things, like it could be motivating the buyer to like adding image value or personal value, like a Rolex. Customer will not be buying a watch, they'll be buying a whole experience. And building up customer loyalty, like by creating a bond with the customer, and clearly delivering the message, like the BMW produces vehicle, or however the brand itself speaks out how different their vehicles are from the others, and like confirm reliability and integrity, where the trust and accountability should be delivered through that particular brand, and fixing the target prospect in an emotional manner. So now when I say branding, what comes to your mind? Like I said, it could be a name, symbol, or sign. Okay, right? When you see an apple, half-eaten apple, you see just that sign. What comes to your mind? Apple, iPhone. Yeah, Apple, right? The brand. We are going in the road and you see a red color board. But you try to look and see whether it's KFC, is it McDonald's? Yeah. You look at the sign and then you know what that shop is all about, right? So those are called branding based on a symbol or a name, right? Now, moving on, there are four main brands, as I told you, there are four main brands. One is manufacturer's brand. So the brand type where the manufacturer sells the good under their own name, like Cadbury, Samsung, Kodak, these are like the name manufacturer brands. Now, it could be own label brands. Now, what is own label brand? This is the manufacturer name does not appear on the product. And it is sold to an intermediary, which is given its own name, known as own label brand. Example, like Sainsbury, Tesco, have their own label brands, right? Like, things that are in the own label. These are called own label brand. But this is manufactured by a manufacturer and given, printed with that particular label brand of the supermarket. Generic. What is generic? The number of generic brands is like the brands that do not have a brand name or the terms of identity, and which has been falling dramatically because of the growing importance of a brand to the customer. Multi-branding is where an organization processes more than one brand. Now, example, you take Unilever or even Procter & Gamble. Doesn't it have a lot of different brand names now under its wing? So this is called multi-branding. Now, brand development strategies, if we just look at the brand, you have this brand name from this side and the product category. So if the brand name is existing and the product category is also existing, then it is basically called as line extension. And however, if the brand name is existing and the product is new, it is called as brand extension, right? So brand name is new and the product category is new, then it is multi-brand. Like I said, like Unilever. So product category is also new and the brand name is new. These are basically new brands. Okay, so moving on, brand name strategies. Now we are going to see how the branded goods are easier to sell. And company today are contemplating on these, and if they are generic products, such as it has to be used. So, so there are several brand strategies which are used by organization. One is brand stretching. So what is brand stretching? It is where a company uses existing brand name to launch like a new product in other countries, categories, such as like Honda. And line extension is the other method, which is like introducing additional items in like the same product category under same brand name. Like this is basically like a low risk and low cost kind of a brand. So then we will move towards multi-branding. Now, what is multi-branding? This is often like introduce additional brands within the same category. It could be like a FMCG market range of brands, which will often secure important space in supermarket shelf. Okay, now talking about new brands. So sometimes an existing brand will not fit in a new product category, like Toyota introduced the Lexus position in a new Lexus luxury brand way. So existing and very successful mass market range. Moving on, we are going to talk about brand equity. What is brand equity? This is basically the added value endowed on product or services because of that particular brand. And it is basically reflecting on the way the customers think, feel, or act, and respect the particular brand. That is what brand equity is. So obviously the brand equity is an intangible assets which associated made by the consumer, and there are three perspectives on the brand equity, which could be financial, brand extension, and the consumer based. So financial perspective, like in one way of measuring brand equity is to determine the price premium that the brand commands over generic product, which is the financial perspective. Now looking at the brand extension, generally like a successful brand would have a platform to launch related products, right? The benefits of a brand extension is that it's leveraging of existing brand awareness and also reducing the advertising expenditure. So it has a lower risk from the perspective of a consumer as well. So product base, that is the third section, where a strong brand increases the customer's attitude, a strength towards the brand product associated with the brand. So attitude strength is basically how it's built through the experience of the brand, and trial samples are more effective than the advertising in early stages of building this particular strong brand. Moving on, we're going to talk about creating brand value. So brand value could be created through what? Effectively communicating to the target market, and should be capable of creating product awareness and influencing the consumer perception of the product. So in an attempt to create brand loyalty, an organization have focus on quality, clearly communicate the benefits, to create an expectation and brand experience and reinforcements of the brand, or creating a brand community. Moving on, we are going to talk about the competitive advantage you get from branding. So this is the basically competitive advantage, a strategic advantage an organization have over the competitor, and it helps to enhance the organization's position. So competitive advantage could achieve through many ways, such as powerful distribution network, excellent cost structure, excellent customer support, unmatched product offering. So basically, for an example, if you take Coca-Cola, they have actually managed to create like a competitive advantage over Pepsi through an excellent distributed network. And the distribution network is so powerful that they assure their customers the availability of Coke anywhere they go, even if it's a boutique shop in the middle of desert. And Walmart is basically unbeatable in retail market as a result of its excellent cost structure. Okay, so now let's look at how brands create competitive advantage. To create competitive advantage should be combined with like a consumer behavior that helps them in buying the same brand over and over again. So it should create brand loyalty using one or combination of like search cost, the user habit, and the switching cost. So where the brand do not create a competitive advantage would be the commodity industry, where wires, plumbing, and things of that sort. It could be capital good, where the goods are purchased not often for a long time. So careful analysis of the option is very necessary, and it's necessary. And highly competitive industries such as long-term in terms of product specification, quality, and their brands in a competitive advantage. And talking about corporate image, it was once like advertising jargon, but today it's a common phrase referred to company's competitor. So image is what the public is kind of supposed to say when a corporation is mentioned. Like example, when you say McDonald's, what do you feel? So this would obviously translate into dollars or pounds at the count and high stock valuation, right? So usually with large companies, have this sort of a corporate image, because when it comes to the companies, like the consumers, actually they try to buy products which they feel have, which is perceived to be of more value, or perceived to be of good quality. So corporations try to shape their image, need to kind of try and make sure that the image in the customer's head is managed as well. So now let's look at how the corporate image is. And we are talking about finances, and you would have wondered, why are we talking about all this? Very necessary, because this is not financial accounting, strategic financial management. So management is entirely different. So finances has to be managed. That's why we are kind of see. Now, how do we measure the corporate image? So first we need to understand the concept and then move towards how it's measured. So corporations kind of evaluate their image such as the politicians do by surveys, where they apply the methodology of marketing surveys and use both the polling and in support of advertising. And they use like statistical methods of extrapolation to project with a sample that the public as a whole think, and corporations of course rely on much harder measures and sales and performance as well. And the theory of corporate image holds that all things are equal, and well-informed public will help a company achieve higher sales and profit, and also whereas a forgetful or poorly informed public may come and hold negative impressions, but the company may ultimately shift more and its patronage towards its competitors. Now, let's look at reputational risk. So, reputational risk is the risk of loss resulting from damage to its firm's reputation, right? So it would lose revenue and increase operating capital regulatory costs, and an event would typically be associated with reputational risk, would be something related to ethics or safety, security, or the sustainability of that particular company. That's how the reputation is being ruined, where the corporate, the trust that the customer has of the corporate is reduced. And this type of risk can be informed in nature, that they can be difficult to kind of realize financially. And if you look at the determinants of reputational risk, there are three things which would be used to determine the extent on which a company is exposed to the reputational risk, whether it's like reputation exceeds to true character or not, or how much external beliefs, or even like the expectations that the person has, which can widen or like narrow the gap and qualify for internal coordination and also affect the gap. Also, now we are going to talk about managing reputational risk. How do we manage it? Educate the shareholders, employees, all the stakeholders related, tone at the top where the board, senior management, oversights, and the policies and procedures, strong, consistent informants are included, continuous monitoring of the threats to reputation, and establishment of a crisis management plan and team, reporting, then checking for stress, testing, instilling ethics throughout the organization by enforcing a code of conduct for the board, and staff developing a comprehensive system of internal control practices, including those which are related to the transactional website. Okay, now we are moving towards goodwill. So what is goodwill? As you can see, goodwill is basically an intangible asset which equals an acquired company's purchase minus the value of its net assets when it is acquired. And now we are moving towards valuing how the goodwill can be valued. So a company can list goodwill on its balance sheet when it acquires another business. So I mentioned that generally goodwill and patents and things as those are not included in the financial statement, but it is included which when you're acquiring another business. I mentioned that, right? So when another business is bought at a higher cost, uh, what the assets and liabilities on the acquired company's balance sheet dictate, then the goodwill equals the acquisition price minus the net assets. So say a business was purchased for 100 million and its assets were worth 80 million, but it had 30 million of liabilities. The acquired business assets should be equal to what? 50, because the assets, that net assets are 80 minus 30, which is 50. An acquired business should record how much of goodwill? It should be 50 million goodwill. Because as I said, the goodwill equals the acquisition minus the net assets. Net assets would be the difference between the assets and the liabilities. So, however, business may not record goodwill that it generates for itself. Using the same example, assume the business was not acquired, but it's worth 100 million and it still has 80 million of assets with 30 million of liabilities. The business would not be able to record the 50 million of goodwill on its own balance sheet. Goodwill can only be recorded when the entire business or an entire section of the business is purchased at a price greater than the value of its assets. So same example, if you're acquiring a new company, you can use 50 million as goodwill, but if it's your own company, it could not be done. So then while you're analyzing the organization situation using something like ratio analysis, don't you have to include these kind of things as well while taking a decision based to the organization as well? So moving on, hold on. So now we will be talking about strategic audit and goal congruency. So a strategic audit can use to identify an organization's tangible and intangible resources to amass its management competency. So what we did with ratio analysis is the checking the tangible basically. And here we also talked about intangible, right? And with this, the organizations or the management's competencies kind of are checked upon, and the resources and competencies of the organization can be understood using this strategic audit. What will be done in a strategic audit? Let's see how it goes. So following analyses are involved in the process. The first one is the resource audit, which identify the resources which are available for the organization and for its operation. Then the value chain analysis. So it will have all the different activities performed by the organization and a tool to identify the activities which the organization is currently performing, and then the activities which need to be improved and the activities that are not core and which can be outsourced as well. And then would be the core competence analysis, where it identifies the capabilities of the organization that are core for its competitive advantage. And there would be a performance analysis, where the three analyses help in identify the strategic capabilities after the organization has to analyze its performance over a time. Then there would be portfolio analysis. We actually talked about it a little bit. This helps in analyzing the strategic business unit, where a large diversified organization has a portfolio of business units under it, and through the portfolio analysis, the companies can assess the areas where the special attention is needed and the areas which are strong. Then we are moving towards SWOT analysis, which means the strengths, weaknesses, opportunities, threats of an organization. And this would highlight the summary of overall position of the environment as well. So basically, we talked about different analyses. We will also not probably in one of the next 2 weeks, we will be talking about things such as SWOT analysis and even things such as PESTLE, where you can try and identify how the market that the company is working on responds. What are the factors that are related to the company. It would be done in one of the 2 days to next week or the week after. So what is goal congruency? This is where an organization is goal congruent when individual departments, divisions work together, focusing on the organization goals. So there could also be sub goals, obviously, and which would have one set of central objectives. And each level needs to include corporate business division level goals, which are goal congruent to the main goal of the organization. And where each industry is very different from one another. When it comes to like a group, what happens is in such group, the vision and mission have to be clearly defined by their strategies for achieving them, to have to be like well planned ahead, and so that every business and division works together to achieve the goal of the corporate parent. Moving on, we are going to talk about business, corporate, and business valuation technique. So what is valuation? So before talking about business valuation, we need to understand what is valuation, right? So what is valuation? This is basically like an analytical process of kind of determine the current or projected worth of an asset or a company. Like there could be many techniques used for doing a valuation. A company can look at the business management, the composition of its capital structure, the prospect of future earnings, and the market value of its assets. All these things will be used in business valuation. So valuation is basically a quantitative process of determining the fair value of an asset, investment, or it could be a firm. So in generally, a company can be valued as its own or an absolute basis, or else it can be relative compared to other companies, similar companies as well. There are several methods and techniques for arrival at valuation, each of which may produce a different level. So valuation can be quickly impacted by corporate earnings or economic events, like even the force analysts to retool the valuation models, and this qualitative in nature. So valuation kind of involves some degree of subjective inputs or kind of like assumptions as well. So valuation, as I told you, a business valuation is known as also a company valuation, which is the process of determining the economic value of the business, right? So during this valuation process, all areas of the business are kind of analyzed in order to determine like its worth of its department or the kind of like the units. So like a company valuation can be used to what? To determine the fair value of the business or a variety of reasons, including like the sales value, the establishing partner ownership, taxation, and even like divorce proceedings. Owners will often turn to professional business evaluators for the objective estimate of value of the business. So valuation include an analysis of the company's management. So its capital structure, its future earnings, prospective or the capital value on its assets, and the tools used for valuation can be evaluated, businesses, industries. All this will be included, and the common approach used for business valuation include a review of financial statement and discounting cash flow models or similar competitors as well. So now valuation is also very important when it comes to tax reporting, because Internal Revenue Service, IRS, requires that a business is valued based on its fair market value. So for that, obviously, you need to know the market value, right? So some tax-related events such as sales, purchase, or gift sharing, gifting of shares of company will be taxed depending on the valuation as well. So moving on, we will be also talking about methods of valuation. Now we are going to see different methods of valuation. So when it valuation, we have different types of methods. One method is market capitalization. So market capitalization is basically like the simplest method of business valuation. So what it does is it is calculated by multiplying the company's share price to the total number of shares which are outstanding. So like example, if I take an example, so let's say January 3rd, 2018, Microsoft traded at $86.35 and with the total number of shares outstanding, which is 7.715 billion. So then how do we value the company? It's $86.35 into 7.715 billion, which would be 666.19 billion USD. So that's how the market capitalization happens. It's very easy because you get the traded for like a company traded in the stock market. This would be very easy to calculate actually. So we just get the traded value for one share and then multiply it by the total number of shares. Now we are moving towards time revenue method. So this under this time revenue business valuation method, like a stream of revenues generated over a certain period of time is applied like to a multiplier, which depends on the industry and the economic environment. Like for an example, like if you take a tech company, it could be valued at 3x revenue, while a service firm will be valued at 0.5x revenue, okay? So this is the times revenue method. Now, the other method is called earnings multiplier. So what is earning multiplier? This is basically, instead of using the times revenue method, the earnings multiplier may be used to get a more accurate kind of picture of the real value of the company. So the company's profits are more reliable indicator, right, for the financial taxes than sales revenue. Therefore, the earning multiplier adjustments future profits against the cash flow that could be invested at the current interest rate over the same period of time. So it is basically the current P ratio to account for current interest rate. So basically here, the profit is considered instead of using the sales value, which was done in the method mentioned before. So the next method is discounted cash flow method. DCF might remind you of different investment analysis methods, obviously. So the DCF method of business valuation is similar to earnings multiplier. So how is it similar? This method is based on projections of future cash flow. So DCF uses cash flows such as the earnings multiplier and which are adjusted to get the current market value of the company. So the main difference between the discounted cash flow method and the profit multiplier method is that it takes inflation into consideration to calculate the present value. Okay. Thereafter, now we are moving towards book value. Now, what is book value? This is the value of the shareholders' equity of a business shown in the balance sheet, and the book value is derived by subtracting the total liabilities of a company from its total assets. Then we are moving towards liquidation value. So liquidation value is the net cash that a business will receive if its assets were liquidated and liabilities were paid off today. So, so this is by no means an exhaustive list of business valuation methods which are used. How there are other methods, like there are replacement value method, there is something called breakup value method, there is asset-based valuation, and still many more methods are used for business valuation. So I've kind of used 6 methods actually, kind of help you to try to understand of 6 main methods which can be used in order to value the business. So basically, when do we value the business? It could basically be during an acquisition or merger. In that sort of situation, obviously, a company needs to value its business, and to that, these specific methods could be used. So now we are going to talk about the limitations of valuation. So now what are the limitations of the valuation? When deciding which valuation method to use to value a stock for the first time, it is kind of easy to become overwhelmed by the number of valuation techniques available and that are fairly straight. There are some which are fairly straightforward and some are very complicated. Unfortunately, no one method is suited for a situation because each stock is different, each industry is different, there are unique characteristics. So at that same time, different valuation methods will produce different values. So same assets or the company, which may lead analysts to employ. So we should basically lead analysts to kind of use the technique which give the most favorable output. So a common example of a valuation is a company's market capitalization. So this takes the share price of a company and multiplies it by the total share outstanding. So if a company share price is 10 and the company has 2 million shares, so the market capitalization would be 20 million. That's the first method that we were talking about. And we mentioned that it is basically an easy method. Where am I going now? Oops, sorry, good guys. Give me just 1 minute till I. Yes, yeah. This is what we were talking about, right? Now we are moving towards another type of concept. One is called economic value added, or the EVA. So economic value added, or EVA, is basically like a measure of a company's financial performance based on the residual value of wealth calculated by deducting its cost of capital from its operating profit. So basically, it could be adjusted for taxes on like a cash basis, and it is also called as economic profit. So what it does is it tries to capture the true economic profit of a company. So it was devised by a management consulting firm called Stern Value Management, which is originally incorporated as Stern Stewart and Co. Company. So EVA assesses what the performance of a company and its management through the idea that the business is only profitable when it creates wealth and return for shareholders. So requires performance which is above the company's cost of capital. So also EVA as a performance indicator is very useful because it shows where a company created wealth, and through the inclusion of balance sheet items, it forces management to be aware of the assets and the expenses when making managerial decisions. However, what are the limitations of EVA? It is heavily dependent on the amount of invested capital and is best used for asset-rich companies that are stable or matured, and companies with intangible assets, such as like technology business, and may not be like a good candidate, which is for a EVA valuation. Now, let's see how it is valued. So EVA is, as I said, the incremental difference in the rate of return over company's cost of capital. So it is used to measure the value of the company from the funds invested. And if it's negative, it means the company is not generating the value from the fund. And EVA shows the company is producing value from the fund. Here, this is how we calculate the EVA. You take the net operating profit after tax. From that, you deduct the difference between the invested capital multiplied by weighted average cost of capital. Now, what is invested capital? This is basically debt and capital leases plus the shareholder equity. So that whole invested capital minus the weighted average cost of capital need to be reduced from the net operating profit after tax in order to kind of identify the EVA or the economic value added. Then we are moving on to another concept which is called market value added. So this is basically a calculation that shows the difference between the market value of the company and the capital contribution by all its investors. So both bondholders and shareholders will kind of use this, and it is the market value of the debt and equity minus its capital claims held against the company. So this is MVA, or the market value added, is V. Is basically where the market value added, V is the market value of the firm minus the value of the firm equity and debt of its enterprise, and it will be the K is the total amount of capital invested in the firm. Sorry. So the market value minus the capital which is invested in the particular firm. So MVA is closely related to the concept of EVA and represents the NPV of a series of the EVA of the value as well. Now, looking at NVA, the companies which has a high MVA are basically considered to be attractive to investors, not only because it has a greater likelihood to produce positive response, but because it's a good indication that they have strong leadership and a sound governance. So MVA can basically be interpreted as the amount of wealth of the management that is created by investors over their investment in the company, and it is able to sustain or increase MVA over time, typically which attract more investments, and it may actually understate the performance of a company because it does not account for the cash payout, such as like the dividends or the stock buyback. All these things will not be included in the MVA calculations. So it sometimes one might say that it is not a reliable indicator for management performance during a strong bull market, such as when the stock prices are rise in general. So now an example for MVA. So Alphabet Inc., Google, the patent of Google, is among the most valuable companies in the world with high growth potential. Its stock returned 1,293% in the first 10 years of the operation, while much of its MVA in the earliest can be attributed to the market exuberance of its shares, and the company has managed to more than double it from 2015 to 2019, and Alphabet's MVA has grown from 354.4 billion in 2015 to 606.20 billion in December 2007 to 809.01 billion in December 2009 to 1.19 trillion in 2020. So this can show how the market share has increased. So that means obviously the market value added would have been quite high, right? Now, the last method that I'm going to talk about is shareholder value added. And now what is shareholder value added? this is like a measure of the operating profit of the company that has produced an excess of its funding cost or the cost of capital. Like the basic calculation would be net operating profit after tax minus the cost of capital based on the company's weighted average cost of capital. So the formula for SVA is the net operating profit after tax minus the cost of capital. So some value investors use SVA as a tool to judge like the corporation's profitability and the management efficiency. So this is in line with the thinking of being congruent with the value-based management, and it assumes that the foremost consideration of a corporation should maximize the economic value added of the shareholders. So shareholder value is basically created when a company's profit exceeds its cost, right? So there is more than one way to calculate this. One is the net profit, which is a rough method of shareholder value added, but it doesn't take into account funding cost or the cost of capital. So SVA shows the income that the company has earned in excess of its funding cost, and the shareholder value added has a number of advantages. Like it uses the NOPAT, which is based on operating profits and excludes the tax savings that result from the use of debt. This removes the effect of financial decisions on profits and allows an apples to apples comparison of companies regardless of their financing method. Now, in NOPAT, or the net operating profit after tax, also excludes what? The extraordinary items, and has a more precise measure than the net profit of a company's ability to generate profits from their normal operations. And extraordinary items include restructure costs and other one-time expenses that may temporarily affect the company's profit. Now, we, I think, need to move on towards dividend policies. We need to see whether we do have time to kind of move on. Actually, we have to talk a little bit extra about dividend policies. So I think we should kind of stop here and then move on to dividend policies next week. So as you know, we were talking about a lot of sections today. So we were basically talking based on industry intelligence and assessing intangibles. So because last week we spoke about ratio analysis, where we spoke about how the information which is in the financial statements can be used in order to kind of analyze the organizations. Now, today we're talking about intellectual property. First, I gave you an idea of intellectual property, like what they are and how they are useful to the organizations, and what the different types of intellectual properties. And I even gave you like the example of a trademark dispute to kind of understand how legally it is protected. And thereafter we talked about a lot of sections like the patent, we spoke about patents and different types of patents, talks about branding, what are the branding methods. Then we talked about sections such as the corporate image. We talked about corporate image, how it is being used. Then we talked about goodwill. So we talked about all these intangible assets and how it can be used in this business decision making. And we said how the strategic audit can be done using resource audit, value chain audit, the core competence audit, performance analysis, portfolio analysis, and SWOT analysis. And I mentioned that we will be talking about SWOT and so on later on. And then we started on business valuation, where we talked about different methods of business valuation, the limitation. Then we moved on to concepts such as economic value added, how to calculate market value added, shareholder value added. We did complete a lot of sections today. I hope you understood. To go in a little bit fast, and I hope you understood what I said. Thank you for listening to me, everyone. Have a good day. See you next week. See you. Hope you have a good week. Bye.